Hello, everyone. My name is Brian Overby. I'm a senior options strategist for Options Play, and we're ready to kick off this event. I see we have quite a few people that are logging in still at this moment, but we're going to start here. The entire presentation is going to take about 45 minutes, and we're going to talk about trading earnings season. If you like to trade option strategies around earnings, there's just some important pricing aspects of the option contracts that the marketplace tells you about. And you need to take this information and use it to try to pick the strategies that you would like to do. I'm going to go through a PowerPoint presentation that will be made available to you, but I'm also going to look at the Options Play platform, and we're going to talk about a company that's going to be announcing earnings here over this week, actually tomorrow morning before the open, Constellation Brands. And it's more so not that that's meant to be a recommendation. It's just the fact that they are announcing earnings. We're heading into earnings season, and there's a few companies that are announcing, but we haven't really got in until we get to the middle of October do we really start seeing earnings season take off. Okay, so with that said, let's jump back to the PowerPoint. We have a small disclaimer. Read that if you would like. And now let's jump into the earnings. Here's the question that we're going to try to answer today. How can I trade earnings seasons with confidence and maximize returns using options? And to me, it's more so, well, the first thing that you have to do is try to have your forecast be correct. Know the way that you want to lean on your trading of options. And then you have to craft your strategy to fit your outlook and use what the marketplace is telling you to actually set up that strategy. And that's what today's presentation is going to be about. If you open up that Q&A box, by the way, I'm happy to address any questions along the way if you would like to do that. So I have no worries or to try to address questions during the show, but I'll also try to answer them after the event. Okay, so, or at the very end, I'll leave time to answer a few of them. All right, so here we go. Okay, now calculating the implied move. I've been an option strategist for a long time, and I've had a lot of reporters calling me from the Wall Street Journal, CNBC, et cetera, and there's a very simple way to sound intelligent when you're talking about stocks around earnings. And if you spent any time in watching the financial news around a major company that's going to announce earnings, you'll a lot of times hear them say the implied move from the options marketplace is going to be 5% after earnings, or the implied move is going to be 10%. What are they doing? Why do they know this information? And it's really just about the math. It's about the demand for the option contracts, and how much demand there is affects the prices, and it gives you a feel for how much an underlying stock, in this case, in our slide, you'll see JP Morgan, will move after an earnings event. Okay, so what we're going to look at is an at-the-money straddle. I like to look on the long side of things, but inside this slide, we have it set up as a short straddle. And what that really means is you're going to buy the most at-the-money option contracts. Or, well, in this instance, we're selling, so I got to flip my script. We're going to be selling the most at-the-money option contracts. Another way to look at it is the 50 delta call. Now, if you've traded options, you know that the most at-the-money option contract usually has a delta close to 50. In this instance, I don't think we have to go that far. We can just say you're going to sell the call and sell the put on that at-the-money option contract. And if you do that, that's what's considered to be the expected move. Now, real important, It doesn't have any regard to direction. So there's no directional bias in the option contracts at all. But it's saying this is the potential move of that underlying. And I, I, the best way to think about it, if you know anything about sports betting or anything like that, is to say it's an over under. It's what the marketplace thinks the underlying can move after earnings. Okay. So, for example, if you're talking about a basketball game, and a lot of times they'll look at what will be the total score between the two teams. And I'll pick a real simple number. Let's say both teams are anticipated to score 100 points, just because they have good offenses, or however you want to talk about it. But then the over under would be 200 points. So do you think they're going to score more than 200 points? Or do you think they're going to score less than 200 points? And in the betting world, you can bet that. And that's that simple. The marketplace is implying that 200 points will be the total score between the two teams, and you can take a direction. You can take a side. How is that number determined? Well, inflows and outflows of cash. That's how Vegas, or whatever gambling world that you're talking about, that's how they determine where that number should be. And it will get adjusted heading into game time and the tip-off for a basketball game. Now, I hope you have some feeling for what basketball is. But with that said, in the marketplace, the same thing happens, right? You're still talking about inflows and outflows of cash. And if people are looking at JP Morgan and they're thinking, well, the potential move of this underlying stock is going to be, well, if I think, let's put it this way. If I'm bullish on the stock and I come in and I'm buying call options and everybody leans bullish and they keep buying the 50 delta call, the most at the money call, and they're buying that, the price of the call will go up because a lot of money's coming in. So market makers have to sell it. They want you to stop buying it. They're going to raise the price. And we call that implied volatility in the options trading world. That also can happen on the put side. So if you look at what the prices of the call and the puts are, it makes sense that this is the price that the markets or the market makers that are making the markets are willing to sell it to you for. And hence, they're thinking that if they're selling that option contract at that price, that the market won't go beyond those prices. So that's where the expected move comes from. It's not anything to do with necessarily a forecast made by anybody in particular. It's monies coming in that are buying and selling option contracts, especially ahead of a known event like earnings. And this is where they can be the most accurate, where they usually, when you have high volumes, marketplaces are more transparent as to what the expectation is. Okay, so in our example here, and I'm gonna, like I said, I'm gonna go through a real life example using the live quotes on the Options Play platform. If we look at this, we're saying the cost of this straddle is $466. So it's $4.66 to do one straddle. That means you're going to sell the most at the money call and sell the most at the money put. Now, on a movement basis, that would mean that you take that price, 466, minus where the underlying stock is at, 169, or I should say divided by 169, And that's implying that there is about a 3% move is what the outlook is for JP Morgan on this earnings forecast, which is fairly low. So this was back in the day. But I would assume the implied move most of the time would be around 5%. And we're going to look at a real life one. Now, you're going to use the most near-term option contract. And this was harder, or you got less transparency when there wasn't weekly option contracts in the marketplace, mainly because you had only a monthly expiration. But nowadays you have weekly contracts, and even in some of the exchange traded funds, you have daily option contracts, so you can even get more of a feel on it. All right. So that is how you sound intelligent to a reporter. And most of the reporters know this. So they would call up and say, hey, Brian, what is the potential, what type of move is the options market implying in JP Morgan heading into earnings? And I would quickly look at what the long straddle or the short straddle is for the most near-term option contract, do a calculation and say they're looking for about a 3% move in JP Morgan heading into earnings. And that's that simple. You're just taking what the marketplace is telling you, and then you are applying that to your strategy. So how can we use this information in our trading, more importantly, right? So in this scenario, you're looking at buying an at the money straddle. So if you're buying the most at the money call and the most at the money put, what are you willing to pay for that straddle? And you have to ask yourself that the market maker is willing to sell this to you at that price, and realize that most of the time, if you're buying at the money straddles, the market is, you're looking at about 7 out of 10 times, the marketplace will actually go more than the long straddle. And so if I'm a long straddle trader, I got to be prepared that most of the time I am not going to be profitable on the trade. If I'm buying the put, buying the call, most of the time I'm not going to be profitable. But when I am, and the market takes off, the profits are unlimited, right? In other words, if I'm buying that long straddle and the market takes off, I have unlimited upside because I'm long a call, and unlimited substantial downside because I'm long a put. So a long straddle trader has to do a lot of them and then be able to make up for the losses when they get one of them right. Most of the time, if I'm buying an at the money straddle, I do not want to do it around earnings. I don't want to do it around a known event. Here's a couple of examples where I have in my podcasts and my webinars just talked about potentially buying a long straddle. And a great example, one of the better trades that I talked about is with Boeing. When Boeing was having all their issues, the MAX plane that had issues with crashing, unfortunately, will they fly again? And there was news that was hitting the markets left and right saying they're going to fly, they're not going to fly, but news headlines were unexpected. And when you're looking at buying long straddles, in my mind, I want to trade those on underlyings that have a lot of news. They're in the marketplace, but the news isn't known when it will hit. If the market knows that there's going to be an earnings report that's going to drive the prices, well, then it's going to be priced accordingly. The volatility is going to be increased, and that's going to be an issue. So I personally don't like to buy long straddles around earnings. All right. Now, if I'm looking at a debit spread, uh, buying the debit spreads around earnings, I want to pay a lot of attention to the time. I want to pay attention to how much time I'm buying versus how much time I'm selling. Okay, so in this instance, on JP Morgan, targeting 60 days to expiration. I personally trade a little bit shorter time frames because if I'm buying a long straddle, you're buying an option, or I'm buying a long debit spread. I'm buying an option contract that wants the market to go up, and then I'm selling an option contract that wants the market to go down. So they battle with each other, and I want them to be. If you're correct on your forecast, you need this option contract that you've sold that's out of the money to uh, to decay, because you have to buy it back. You have to close that position. So when does that option contract have the least amount of time premium in it? Well, it's closer to the expiration date. So in this instance, if I'm looking at these trades, I like to do them a little shorter because I'm doing it based off of the known event. And I'm going to talk about, if I'm really just looking at a directional play based off of earnings, I'm going to use the software to try to set up one with live quotes in Constellation Brands. All right. And those are debit spreads. Now, if you're selling credit spreads and you're going further out of the money, and we're once again going to pay attention to what the marketplace is telling us the potential move is, we want to go further out of the money. As a matter of fact, I want to go quite a ways out of the money if I'm going to be selling vertical spreads around earnings. Now, this is a little bit more of a scary situation because there's an unknown event. You get paid for that risk, but anything can happen with an earnings report. So I prefer to do debit spreads as opposed to credit spreads, only because I want to pay a little and get a lot as opposed to receive a little and have a higher potential of risk. Okay, so in this instance, on this slide, talking about 45 days to expiration, once again, I would want to do shorter, and I'm going to show you a couple of examples based off of that. And we're going to sell in here an at the money call and then buy an out of the money call. So now in this instance, I'm saying the market is going to go down. And if I do this, I want to collect at least 33% of the vertical width. Okay, so in this example, we're looking at a 5-point credit spread. So quite simple. If I'm going to put this trade on by saying a third of the width, the credit that I want to bring in is 5 times 0.33 or $1.65. And the marketplace should know this risk, and it should be close to that price by selling the 50 delta and by buying the 25 delta out of the money. All right. So I will focus on this, and I'm going to come back and show you a little bit more to go along with this, how I'm going to approach these around an earnings report. Okay. So let's exit this PowerPoint, and we're going to go over to options play. And I have this all set up to look at the trades that we want to do in Constellation Brands around earnings. Now, we're going to get, if we're looking at high implied volatility, this is where the straddle is at. And we're going to modify this, okay? So let me show you how I'm going to set this up. If I'm looking at the long straddle, that means I always like to think of it on the buy side of things. If I would like to buy the long straddle, Constellation Brands, by the way, is announcing earnings tomorrow morning before the open. The stock right now is trading at 255.27. It's down $2.42 or about 1% on the day ahead of earnings. So you have the rest of the day to look at this trade. Now, I also want to emphasize this is not meant to be a recommendation. I picked Constellation Brands because they're announcing earnings tomorrow. You can take this and apply it to any underlying that you want to trade. When the earnings season hits, which is about October 15th when the stocks start taking off, JP Morgan is the first financial company that usually announces earnings. And that's usually, a lot of people think of that as a kickoff to the major earning seasons for most of the companies. Okay. Now, we bought one and we bought one. We got a call, we got a put. All right. And everybody is seeing my mouse, right? I just want to make sure that when I point to it, yeah, I know that we are. I recall that from the last event that we did. If you have any questions, you can put them in the Q&A box. Just want to let you know, so feel free to share that. And 1 second here. If I'm doing this trade, now I don't want to go 44 days out because all I'm trying to do is get a feel for what the marketplace thinks will happen after the earnings report. So today is Wednesday. They're going to announce on Thursday before the open. There are weekly option contracts in here. So October 4th is the expiration date. That is the expiration that I want to focus on. So in this instance, if I put up the long straddle here and we look at the total cost of the trade, it's $8.65, or for every 1-by-1 straddle that you're buying, you would be paying $865. So what is the expected move? If the reporter calls you up and says, what is the marketplace saying about the potential move of Constellation Brands after earnings? You take $8.65, and we're dealing with live markets, by the way, so I'm doing everything live as we go. And you say here, based off of where the at the money is straddle is trading at, which is $8.65, and then you divide that by the actual underlying stock, which is $2.55, and you see that right now the marketplace is implying about a 3.4% move after earnings. Now, this is one thing that the marketplace, or that the reporters or the pundits on the financial shows don't say, is that's including Friday. That's not just Thursday after earnings. A lot of times they leave that information out. But if you're using the options with a Friday expiration on the close, well, that is what the expected move is implying. It's implying that range. Okay, so 3.4% is the outlook for the marketplace, or around $8.65 after earnings. All right, so if I'm doing long straddles, or if I'm doing long trades, okay, and let's go and get bullish on this, and let's buy a vertical, okay? So on this vertical that we're looking to buy, I would modify this. I want to make sure that I stay within that expected move, right? So the options play software defaulted to basically, without thinking about earnings, it defaulted to selling a 280 strike call. If I'm buying the at the money call and I'm selling an out of the money call, I want, and especially if I'm staying in the short term, I want to be within that expected move. I want to sell an option contract that the marketplace thinks the stock could get to based off of the price of the at the money call and the at the money put. So I don't want to go more than 10 points. I don't mind that it gets close, but right now the expected move is $8.65, or I didn't write it down, somewhere close to that. So if I'm going to look at a strike, first of all, I'm going to move my expiry closer. And we can go 9 days. I don't mind doing the 9 days. We needed October for the October 4th for the long straddle to set realistic expectations. But now we're going to do the October 11th expiration. And if we come back, we're going to go 10 points out of the money. We could go 5. So it's in between because it's $8.65. But I don't mind going 10 points on this trade. We're paying $5.80 for the call. If we do the midpoint price, which if we're entering this as a spread inside the platform, we're going to try to fill somewhere close to the midpoint. Let's look at the trade on this position. All right, so paying $5.70, receiving $1.83 means that we're looking at a midpoint of $3.87. So $387 for every 1-by-1 spread that we put on. That is going to be our max risk. And once again, it's going to be a good fill. Inside, or that would be a good fill, I should say, if you're trading at the midpoint. But around earnings, this is one of the benefits. There's increased volatility. And usually trading somewhere close to the midpoint is not hard to do, but there's never a guarantee that it's going to happen. And any fees that you may pay to get into the trade, but with first trade, obviously, there's very little fees at all, if any at all. So $387 will be our max risk. So $10 minus $387 is $6.13. So our risk is $3.87 on this trade. And our upside is, or our maximum potential upside is $3 or $6.13, or $613 for every 1-by-1 spread that you put on. Now, looking at the checklist, notice that this is highlighted because it's telling you when that earnings date is. So this is a real nice feature of the options play strategy checklist, is to know that, oh, by the way, this is our situation where we're at. And liquidity is a little tough in this underlying. So I do agree with that it's just highlighting the fact that there are fairly wide bid-ask spreads on the trade if you're entering it. But that's good to know. But we're trading around earnings. We're still going to try to trade somewhere close to this level. So $3 and so $6.13. It means that we have about a 60% upside. We're putting up about 40% of the width of the spread to put the trade on, and we're staying within the expected move. We're staying within the outlook after earnings for that underlying stock. So I don't want to push the boundary. I don't want to go and sell the 270 strike call, because the marketplace, I'm trading earnings. I'm trading this based off of earnings. I'm not doing this because I want to own Constellation Brands for the next 6 months. Right? I'm doing it because I think that they're going to have a solid earnings report, and I want to take advantage of that movement for that earnings. Now, another way to look at this trade is to say, well, I'm going to do it at shorter term, and I'm not going to risk as much. So the expected move was $8.65. Well, I might do the 260 here. If I do the 260 trade, I'm buying the 255, selling the 260 on the trade, and then let's look at the trade here. Now I'm paying $2.35. I have less upside. I have less upside, but I'm putting up less debit to start with. So I have less downside risk on the trade. So in this instance, I'm risking $2.35 to make $5 on the trade, but I'm still within that expected move. And I'm going out, I'm giving it a little bit more time. I'm not taking the Friday expiration. I'm going to give a little bit of time for this trade to play out, and I'm going to go out to the October 11th expiration on this trade. Now, everything that we said here can apply to the put side. If you want to get bearish, buying the at the money, selling something that's within the strike price or within the expected move, that's how I want to approach any long spreads that I'm doing. So let's go in and let's do this on the bearish side. And I'm going to adjust my trade a little bit. Mainly because there's another way that I like to trade long spreads. And I should emphasize this, that if I'm trying to trade around earnings, I very rarely am just going to buy a call or a put outright. Mainly because I don't want to be in it too long anyways. And I don't want to pay up for that known news event like we talked about with the long straddle. So I'm almost always going to do a long call spread or a long put spread as opposed to just buying options outright. Now, if you buy options outright and the market gaps double the expected move in your direction, well, yeah, you look like a genius in that instance. So there are times where you may feel bullish or bearish enough to just buy an option outright, but most of the time that's not my feeling on it, and I'm going to trade a long spread either on the call side or the put side of things. Okay. So everything applied on the call side, you can flip it around and you could be bearish and apply that on the put side. But I'm going to show you one of my favorite ways to just trade long put spread. And you can also apply it to the call side. So let me set up the long put spread. One of the ways I like to trade them around earnings. I want to trade it and basically take the time premium out of the option contract. So let me show you what I mean. Okay. So because of everything that we just talked about, how the math is in the marketplace, how what's the cost of the long spread, and what the risk and reward is based off of that. If you straddle the stock and you go equidistance in and out of the money in the marketplace, because we're using live markets is being kind to me, because we're going to have an at the money strike here, very close. $255 is that, so we can look at the at the money 255 call and put. All right, so if I'm going to get bearish on this stock, we're going to modify this trade. Let's do this one. And the vertical is better. Okay, modify the vertical. Okay, so we're going to go out. We'll stay in that same expiration, the October 11th expiration, 9 days away. And the market's at 255. So we're going to buy the 260. We're going to go 5 points in the money on the put side, right? So with puts, you kind of have to think backward. If I bought it on the market at 255 and exercised, I could sell it at 260. So that's one, you got to think backwards with puts, right? And let's leave it there. We'll go 10 points because we'll be within the expected move. Okay. And now I expect this to be trading close to $5. And I'm telling you, we're using live markets, but I'll explain to you why I know that after we pull up this strike. Uh, 260, I need the 250s. So if we're at the midpoint, we hit trade. And you see that it's trading for $4.57. And the reason why it's not exactly at $5 is because we're not exactly at the strike price. Okay, so now let me tell you how I know this. All right. If you are buying options and this is very important on long spreads. This is one of my, I guess, one of my favorite trades to do around earnings is to have a forecast on the earnings, and I want to make it all about the stock price movement. That means that between the stock goes down $5 in our instance to 250, well, we're happy on this trade. And from 250 and below, well, I'm not going to play anymore. I'm going to take my ball and go home. So I'm happy if it gets to 250. It doesn't matter if it goes below 250. On the other side, on the risk side of things, we're going to buy the 260. So once again, if it goes up to 260 and beyond, well, I lost my $5 or $4.57 in this instance, and I'm going to take my ball and go home. I'm not playing anymore. But in between those strikes, that 10 points, my trade is active. It's very active. And if you bought the stock outright, your break even would be 255. Well, when we did the trade, 33, right? That's where you bought your 100 shares of stock at. That's where your break even would be at. If we go and look at the 260 strike, right? If you take 260 minus 457, that means our break even, and that would be our break even on the trade, is 255.43. Almost where the stock is at, right? And there's a method to this madness. I knew that this would trade fairly close to $5, and it's a little bit at 255.31. It's not right at the money, or it would be very, very close to $5. But the risk reward plays out. You're buying as much time premium as you're selling. You're going I'm going to say it many different ways. You're going 5 points in the money, you're selling 5 points out of the money. You're going to have intrinsic value on the option contract that you're buying. 720 is where that's trading at. So you are selling, if you think of this, you have $5 of intrinsic value approximately, and that means you have $2.20 worth of time premium. On the other side of thing, the out of the money put is $2.63. So you're buying almost as much time premium as you're selling in this instance. All right, Ray's going to be leaving us, and he let us know that. And yes, there will be a recording, and we'll let you know. Please do put questions into the Q&A box, and I appreciate the nice comments, Ray. We am happy to address them. Like I said, this is an advanced seminar. This is more of a seminar on pricing, and it's mainly because around earnings, pricing is a big deal on the option contracts. So this is my favorite way to look at it. And we talked about buying the out of the money options on the call side, but now just to show you that I'm not pulling your leg by just doing this on the put side of thing. If we go to the call side, it's going to be trading a little bit more than the put. And I love that it's staying right here at 255. It's really helping out this event. So here's the put side of things. Let's go back and let's look at the call side of things. Let's grab a call vertical. Let's modify it. Use the same expiration, 9 days away. And now we'll straddle it the other way. So we're going to go and buy the 250 strike call. We're going to go in the money on the buy. And then we're going to sell the 260 on the other side. And now let's trade it. Ta-da! Notice it's trading for a little bit more than $5 because now we're a little bit more in the money on the call side. Well, we're in the money, I should say. On the put side, we're a little bit out of the money. And so now this is trading for $5.55. So once again, on the call side of things, we are buying just about as much time premium as we're selling. So, what is the moral to my story here? If we do these trades and you want to legitly trade on earnings and you want to remove the weird options things that happen with implied volatility and everything and make it all about the earnings and all about the price, this is the way that I would trade it. Straddle the stock, buy just as much time as you're selling, make sure that you're within the expected move. So in this instance, the expected move is $8.65. So based off of that information, you're either going to lose 555 in theory, or the market, if it makes the move to the upside, make $4.45 on the upside. Or if the market goes nowhere after earnings, which in Constellation Brands, it's not that exciting of a stock, so it might just sit right where the earnings is at. Well, I'm at break even. I sell, I get out, and I should basically act like I owned 100 shares of stock. And that's the way that I like to trade around earnings. All right. Mr. Anonymous is saying, would it be wise to apply this strategy using calendar spreads during earnings? Okay, calendar spreads. I just recently did one inside the daily play portfolio, and that's a different beast. Okay, I like calendar spreads around earnings. And let me see, I'll bounce out of this and go back to the PowerPoint to address any questions. And by the way, I'm done with the presentation. So I'm happy to address any of the questions. If I can get there, Mr. Anonymous, we'll come back to that. And I'll talk a little bit about my outlook on a calendar. Let me see if I can get the simpler questions done first. Bob says Brian. And so Brian says Bob. Back to you. So we answered that one. And then where is the expected move on options play? Well, Mr. Motley or Mrs. Motley or whomever, the expected move isn't outlined, but it's very straightforward. If I look at high implied volatility, that's the expected move right there. All I got to do is put this in, but I do need to modify it. I do need to use the nearest expiration, but that's the expected move right there. The cost of that straddle is the expected move. But it's as far as I know, and I am new to the company. I've only been working with options play now for I guess we're going on a month. But this is expected move is much different than standard deviation, those type of things. It's not necessarily published in most places. Okay, so Bob's back. Hi, Brian. I would like to talk with you. Please let me know how I can reach you. All right. First trade customer for 10 years. That's awesome. Bob, if you want to send me an email, I am the author of the Options Playbook. You can send it to support@optionsplaybook.com. And I'll try to address any questions. Oh, I see. Okay, Anonymous is the light bulb went off with Mr. Anonymous inside the questions. And all right, I think we've addressed most of these things. Okay, so let me pull this back. I'm going to try to mess around a little bit in here. You know what I'll do is I'll share the playbook with you. This is my website, optionsplaybook.com. And let me look to see, I'm going to pull up inside the daily plays, if you are a subscriber to options play, I recently did a trade based off of calendars. And here's the thing that's fun about a calendar spread. Okay, a calendar spread means you buy an option contract with a longer term expiration, and you sell an option contract with a shorter term expiration. Oops, that wasn't supposed to happen that way. Oh, there you go. We'll leave it right there. Oh, that was the old one. I'm messing up. Okay. So let me find this. Let me stop sharing. I'm trying to find the one trade that I've did because it's a fun trade to talk about. And I think I finally got there. Okay, here's the portfolio, and then we'll leave it here. So as far as this presentation, I'm going to say this presentation is done. If you want to stick around, I'm going to look at a play that I recently did inside the options play daily plays that deals with stock that's going to be announcing earnings and the way that we're approaching that trade. XOM, DH. Okay, so Shopify is going to be announcing earnings. Here's what the trade looks like if you're looking at the profit and loss calculator for Shopify. And what I look to do, November, the last week or the first week in November is when they're announcing earnings. They don't have it locked in because you're not close enough to the date. But here's one of the things about earnings and what usually happens around earnings, right? So the November 15th expiration is the one that I chose because I wanted to make sure that you're long enough in time that you're beyond that earning expiration date and it's not locked in stone yet. It probably will be around the 15th of October. They'll have the official date locked in. So what happens to option contracts as earnings approaches? See if we learned something today. What happens to option contracts as earnings approach? And you can answer in the chat box if you want to play in my reindeer games. Or the Q&A box, I'm sorry, not the chat box. What happens to implied volatility? Prices go up. That's fair. I'll take that. Yes, that is correct, Sandra. Prices go up. They increase. Okay, so if you are doing a calendar trade, and when we put this trade on, the market was at, the outlook was a little bit bullish. The market was at $78. We did an 85 strike call in that instance. So we're looking for a decent move to the upside. But, so we're targeting the price right up around 85. I would expect as earnings come in 99% of the time, this option contract, independent of the price, is going to go up. What's going to happen to this option contract, this 85 strike call? Well, usually the stock settles in, waits for earnings, and implied volatility goes down. So you're paying a lot for this option because it's around earnings, but you know that as far as implied volatility is concerned, you're taking this piece out of the picture because you think the underlying market is going to go up. I do not want to be in this trade around earnings. I want to be out of this trade. So I'm hoping that the bullish forecast that came up inside the options play platform is correct, and the market is going to move towards this 85 strike. Ideally, I would like it to go to, where was it at? 78. I would like it to go to 80 and let this call expire, and then let me sell another 85 strike call with a couple more weeks to expiration, and I could get 2 calls sold into this based off of this 85 strike. And then ultimately I wanted to start moving towards 85, and then the day before earnings, if everything plays out, I'm talking about a perfect scenario, I close my entire trade. These option contracts here would expire on the 18th. Hopefully I get to sell another option contract, but now I'm trying to get volatility to be my friend. I know it's going to go up. I still need my forecast to be correct. We got to go towards that 85 level, but I'm going to sell this option contract. And if you think of it, I could even get long this contract going into earnings at a much cheaper price, because let's say this goes out worthless, right? And then all of a sudden I got that premium from what I sold to pay for this option contract. This is the way that I would approach a calendar around earnings. I would pick a direction. I would make sure the one that I'm buying is going to benefit from the implied volatility increase as earnings comes in. And the one that I'm selling, I'm hoping just kind of goes away, withers away, waiting for that big known event to happen. But I still need the stock to go in my direction. And I can do this on the bear side of things. If I want to get bearish on Shopify, I can go in and I can also do that trade. That's simple and straightforward. And yeah, that's my little ugly mug talking about this trade in Shopify. Alrighty. So I want to emphasize today that if you're looking at the strategy and Constellation Brands, I don't mind that you want to trade earnings, but you need to trade earnings because you want to do it, because you want to trade on this underlying stock. I picked it because they're announcing tomorrow, and I wanted to give you real life examples. I wanted to go along with things, and if I'm trading earnings, I don't like to go out to the 60-day level. And I'm not really big on selling credit spreads, but if I'm going to sell a credit spread, it's going to be outside of the expected move, right? If I'm selling a call option, I'm going to go more than 8 points on the upside. And if I'm selling a put credit spread, I'm going to go more than $8.65 on the downside. As a matter of fact, I might go double that. And that would be my number, because you're still going to get some premium based off of the implied volatility. But I'd much rather have a risk reward around earnings of either 50-50, or as it said in the PowerPoint, where I'm paying about 30% of the width, and then I got 70% of upside on the trade. We're really running out of time. Okay, we're almost at an hour now. Great presentation. I appreciate that, Nit. All right, I think we addressed all the questions. So with that said, thanks for stopping in, and there we go. Thanks for stopping in. My name is Brian Overby. You can follow me on Twitter. My handle is @BrianOverby, at my name. And I'll do this right here. And I'll be back. I'll be doing a lot more of these things, but this is a fun one for me. I like to talk about earnings. I like to look at it now, realize that it is a speculative thing to trade around earnings. You need to manage your risk accordingly. You're looking at doing a small percentage of your portfolio on each and every trade, and you want to try to build up that portfolio, that speculative portfolio, slower as opposed to faster. Make sure that you're working right within your means, especially if it's your first time trading option contracts. I like long spreads. I don't mind doing a calendar spread, but that takes a little bit more advanced notification if you're going to be doing the long calendar spreads. But I do appreciate the questions. That's it. I'll see you next time. Check me out on x.com @BrianOverby. Thanks for coming, everyone.